If you filled up your car this month or watched your grocery total climb higher than you expected, you're not imagining it, and you're not bad with money. Prices are rising at their fastest pace in 3 years. Energy alone is up over 20%. Gasoline has jumped more than 40%. Groceries, rent, insurance, all climbing faster than most paychecks, while real wages quietly slip instead of rise. Here's what almost nobody is telling you. While most people watch their bank balance shrink in real terms and panic scroll the news, the families who already built serious wealth are doing the opposite. They redesigned their portfolios for exactly this moment years ago. Right now, they're simply collecting the results while everyone else loses ground. That's the gap I'm closing for you today, in plain, usable terms, with no jargon left unexplained. Because here on Wealth Forge, we don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. If you're new here, architect is what I call the people in this community, not because it sounds nice, but because it describes a specific posture toward money. A follower reacts to what the market does to them, absorbing whatever the headlines hand them. An architect designs the structure that decides in advance how they're going to be affected, long before the headline ever hits. Today, I'm going to walk you through exactly what that structural design looks like when the threat is inflation that isn't going away anytime soon. Let's start with why this matters, because I think a lot of people are still treating this like a weather event, something that blows through and clears up. I don't think that's an accurate way to see it anymore, and I want to show you why in plain terms. For the last several years, the pressures driving prices higher haven't been simple, one-time supply hiccups. They're structural. Energy markets have been repeatedly rattled by conflict in the Middle East, and every time oil and gas prices spike, that cost doesn't stay in the energy sector. It bleeds into shipping, into manufacturing, into food, into the price of literally everything that has to be transported or produced using power. Layer on top of that years of tariff policy pushing the price of goods higher, a housing and shelter market where costs keep grinding upward, and a government that continues to run large deficits funded by more borrowing. Put those pieces together and you get a pattern that behaves less like a temporary spike and more like a new floor. Prices go up in a burst, they cool off slightly, and then something else, a new energy shock, a new round of tariffs, a new shelter cost adjustment, pushes them up again. 3 consecutive months of acceleration is not noise, that's a trend establishing itself. We've actually lived through a version of this before. Back in the 1970s, a run of oil shocks combined with heavy government spending produced a stretch of stubbornly high prices that lasted for years, not months. Economists eventually gave that decade its own name, stagflation, because prices kept climbing even while economic growth stalled out, a combination that wasn't supposed to happen according to the textbooks of the time. The people who came through that period intact weren't the ones holding cash in the bank or locked into low fixed-rate bonds. They were the ones holding real property, productive land, and hard assets that repriced alongside the very inflation eating everyone else alive. Real estate in particular became one of the defining stores of value of that decade because a home or a piece of productive land was, and still is, something people need regardless of what the headlines say. History doesn't repeat itself perfectly, and I'm not telling you this decade is a carbon copy of that one, but the mechanism, energy shocks translating into broad, sticky price increases that outlast any single news cycle, is the same mechanism, and it rewarded the same kind of positioning then that it's rewarding now. Here's why this is dangerous for the average portfolio, and I want to be very specific instead of vague about this. Picture a typical account, mostly stocks, a slice of bonds, and cash sitting in a savings account for safety. That structure was built for a world where inflation was low, boring, and predictable, roughly 2% a year, the kind of number nobody thinks about. It was never designed for a world where prices can jump several percentage points in a single year because of an energy shock on the other side of the planet. Bonds get hurt when rates stay elevated to fight inflation. Cash gets quietly eaten alive. Every year you leave a large balance sitting in a checking or savings account earning next to nothing. While prices rise 4%, you have effectively taken a 4% pay cut on that money without doing anything wrong. You didn't overspend, you didn't make a bad trade. The ground just moved underneath you.
Let me show you exactly why bonds struggle here, because most people own them without ever understanding the mechanism. Say you bought a 10-year bond paying 3% a year, back when it felt like a perfectly reasonable return. If inflation then runs at 4% for a stretch of that 10-year period, the fixed interest payment you're receiving is losing ground to rising prices every single year you hold it. You're earning 3% on paper, while your actual purchasing power falls behind by roughly a percentage point annually. And if new bonds start being issued at higher rates to compete with that inflation, the market value of your older, lower-paying bond drops too, because nobody wants to buy your 3% bond when they can get a new one paying more. That's the double bind. The income falls behind in real terms, and the resale value of the bond itself can fall at the same time. None of this makes bonds worthless. They still have a place for stability and short-term needs, but it explains precisely why safe fixed income allocations can quietly underperform during a structural inflation stretch, even while the account statement looks perfectly calm. Let me put an actual number on that, because vague warnings don't change behavior, specifics do. Say you're sitting on $50,000 in a savings account earning a token amount of interest, essentially flat after taxes. If prices keep climbing at something close to the pace we've seen over the last year, that $50,000 doesn't buy $50,000 of goods and services 5 years from now. Depending on how persistent this stretch turns out to be, it could easily buy somewhere in the neighborhood of $40,000 worth in real terms. Nobody withdrew a dime, the number on the statement didn't move, but the actual purchasing power, the thing that number was supposed to represent, quietly walked out the door. That's the invisible cost nobody puts on a bank statement, and it's the exact cost the structure I'm about to show you is designed to cancel out. I want you to sit with that for a second, because this is the pain point underneath everything I'm about to show you. It's not really about the price of gas or eggs. It's about the slow, quiet transfer of purchasing power away from people who hold cash and fixed return assets and toward people who hold things that rise in value alongside the very prices that are climbing.
That transfer has been happening for years. The only question is which side of it you're standing on. So let's talk about the possible solution. The actual mechanics of how the sophisticated money protects itself. Because this isn't mysterious or reserved for billionaires. It's a set of principles anyone can apply once they understand the logic. The first principle is this. During a genuinely structural inflation stretch, ownership beats lending. When you hold a bond or leave money in a savings account, you're lending your money to someone else at a fixed rate, and inflation quietly erodes the value of what they eventually pay you back. When you own a real productive asset, land, a building, an energy project, a piece of infrastructure, physical gold, the asset itself tends to reprice upward alongside the very inflation that's hurting the lenders. You're not betting on inflation, you're simply standing on ground that moves with it instead of against it. You've probably noticed this playing out already if you've paid any attention to gold this year. It has been setting one record high after another, pushing past $5,000 an ounce and climbing further from there, up sharply just since January. That's not a random speculative spike. A huge share of that buying is coming from central banks around the world, purchasing gold at a pace several times higher than what was normal a few years ago, specifically as a way to diversify away from currency-based assets they no longer see as unconditionally safe. When the institutions that print and manage currency are quietly stockpiling a hard asset instead of trusting their own paper, that tells you something important about how the professionals are actually positioning, regardless of what they say in public interviews. I want to be fair about this and give you the other side too, because an honest architect shows you the load limits of the materials, not just the highlights. Gold pays no dividend and no interest. It sits there. If sentiment shifts, if rates move in a different direction, or if the geopolitical picture calms down, gold can give back a meaningful chunk of a run like the one we've just seen. That's happened before, including a sharp multi-year drawdown back in the early 1980s after the last truly historic gold run. So this is not buy gold and never think about money again. It's one pillar in a wider structure, sized sensibly, not the entire foundation. Now, gold is one piece, but I don't want you to think this is a buy gold and hope strategy. That's not architecture, that's a bet. The actual blueprint has several load-bearing pillars, and this is where it starts to look like a genuine structural design instead of a single trade. Pillar 1 is real, productive land, farmland, timberland, or land tied to essential resources like water rights. Land doesn't need to be predicted correctly to hold its value. It produces something people need regardless of what prices do, and the income it generates tends to rise right alongside cost. You don't need to buy an entire working farm to get this exposure. There are structures, direct fractional ownership, land-focused funds, and partnerships with working operators that let an everyday architect hold a real titled stake in productive acreage without ever having to drive a tractor. Pillar 2 is energy and infrastructure exposure, ownership stakes in the physical systems that move power, water, and goods around the country. These assets often come with contracts that are directly tied to inflation indexes, meaning the income they throw off is built to rise as prices rise, rather than sitting fixed while the ground shifts beneath it. Think pipelines, power generation assets, and utility infrastructure, the unglamorous backbone of the economy that keeps generating revenue in good years and bad, because people don't stop using electricity or water just because prices are climbing. Pillar 3 is private credit, lending your capital directly into deals at negotiated rates, often well above what a bank's savings account or a traditional bond will ever offer you, with the terms and collateral structured by you or your team, rather than dictated by a distant institution. Picture the gap in concrete terms: a savings account paying you close to nothing, sitting next to a well-underwritten private credit position secured against real property, paying a rate several points above what a bank would ever offer you. That spread, compounded over years, is a large part of how family offices quietly outrun inflation while everyday savers fall behind it. And the collateral behind the loan is what keeps that higher return from being reckless instead of smart. Pillar 4 is precious metals, held as a genuine store of value rather than a trading vehicle, the ballast in the structure, not the whole building. This is the pillar that doesn't produce income and doesn't need to. Its job is simpler and quieter. Hold its purchasing power when currency-based assets are steadily losing their own, and sit calmly in the background while the other 4 pillars do the heavier work of actually generating growth. And Pillar 5, the one almost nobody talks about, is the account structure itself. Most people never stop to ask why their retirement account can only hold stocks, mutual funds, and bonds from a narrow list of brokerage decided on. A self-directed structure lets you hold real assets, the land, the private credit position, even certain physical metals inside the same tax-advantage account you already have. Same government-created tax treatment, completely different foundation underneath it. In practice, that means the private credit interest payments or the farmland income can grow inside that account largely shielded from yearly taxation, the exact same way a stock dividend would inside a normal retirement account, except now the underlying engine generating that growth is tied to real assets built to move with inflation instead of a basket of paper securities that inflation can quietly hollow out. That's the actual blueprint. Own productive things instead of only lending your money out. Diversify the type of ownership, land, energy, private credit, metals, so no single piece of bad news can take down the whole structure, and house it inside the account architecture that lets the growth compound with a tax treatment already working in your favor. Here's where I want to be completely honest with you, because I think you deserve that from anyone talking about your money. I'm not a licensed financial advisor or a tax attorney, and nothing in this video is personalized advice for your specific situation. Your income, your goals, your risk tolerance, and your family's needs are unique to you, and any real decision should go through a qualified professional who can look at your full picture before you act. What I'm giving you here is the education, the way these structures actually work, and why the wealthiest families have leaned into them for generations. What you build from that education is yours to decide. I know the honest objection running through some of your heads right now is, this sounds like it's for people who already have a lot of money, or it sounds complicated. I understand why it feels that way, and I'm not going to pretend that feeling comes from nowhere, but neither concern turns out to be really true once you see the mechanics up close.
Family offices didn't invent private credit or self-directed accounts. They simply had access to people who explained the mechanics clearly. The paperwork to open a self-directed account looks almost identical to opening any other retirement account. The complexity isn't in the structure itself, it's in nobody ever walking you through it in plain language before now. That's the entire gap this community exists to close. This isn't locked away for later, and it isn't reserved for people with a family office already. It's available to you starting with the very next decision you make about where your money sits. Now, if what I've just described sounds like exactly the kind of protection you wish you already had in place, that's precisely why I built the Wealth Forge community. This isn't a place where I sell you a hot tip and disappear. It's where I walk architects step by step through the mechanics. How to actually open and fund a self-directed account. How to evaluate a private credit deal so you're not walking in blind. How to think about land and energy exposure without needing to become a professional commodities trader overnight. We've already gone deep on self-directed retirement structures, on the tax strategy side of holding real assets, and on how private credit actually works behind the scenes. All of that is sitting in this channel right now if you want to start applying it today. If you want more than the free education, if you want the actual walkthroughs, the deal evaluation checklists, and direct access to ask me questions about your specific structure, that's what the Wealth Forge Inner Circle is for. It's the next step for anyone who's done watching from the sidelines and ready to start building. I'll leave the details on how to join right below this video. Think about where this leaves you. Watching another video about inflation changes nothing on its own. Understanding the structure is a step further, but actually building it, moving even $1 out of a slowly eroding savings account and into something productive, that's the moment you stop being a passenger in this economy and start being the one who designed the vehicle. Before you go, I want you to genuinely ask yourself one question, and I'd love to see your honest answer in the comments below. If prices keep climbing at this pace for another 5 years, is your current portfolio built to grow with that reality, or is it quietly built to erode with it? Tell me where you stand. I read every comment, and some of the best video ideas on this channel have come directly from that ongoing conversation between me and this community. Because that's really what all of this comes back to. We don't follow the market, we design the moat. In a world of followers, we are the architect of our own freedom. Next time, I want to take you inside the account structure I mentioned today, the exact type of retirement account that lets you legally hold land, private credit, and real assets under the same tax advantages you already have, and the specific paperwork and providers that make it possible. If today's video showed you the blueprint, next time I hand you the keys, walk you through opening the door yourself, and show you exactly which paperwork gets it done. I'll see you there.